David, why don't if one of my colleagues, David, could you help us and then go through home building, which is an example of one of our investments and how it manifests itself and how all of this, where the rubber meets the road. Thanks,
Sure.
David.
Thanks, Bob. So my name is David Kessler. I'm a portfolio manager with the Robotti. And the example that I'd like to take you through is one that's worked out very well for us. And we continue to believe will have meaningful returns going forward. So Builders FirstSource is the largest domestic supplier of building products to professional home builders. Now, it's ironic because if you ask most experienced investors where you should look to find great stock ideas, a very common answer will be where everyone else isn't looking. But in practice, very few actually look there. So as cyclical businesses, such as building products distribution, begin to experience tough times, capital rushes for the exits, and very often in businesses of cyclical industries, the stocks will trade for far less than what it would cost to replicate that business. And that might make sense in the moment because the earnings at that time don't justify replicating those assets. But many cyclical businesses, such as home building, are essential and are clearly going to rebound, often to previous levels, if not grow from that point. So they're businesses you would want to replicate at some point because they will be able to generate more cash than with the value of their assets, or at least the best of the survivors will. And I want to make that's a critical point, is that you really need the experience to be able to pick out the best of those survivors. So here at Robotti, we have a group of 14 investment professionals, and we all share a common passion for investing, and particularly for uncovering hidden bargains. Now, each of us is drawn to different industries, different situations. We all have different experiences to draw from, but we're all in search of the same thing. And our individual passion combined with our constant collaboration is really one of our strongest competitive advantages. Now, all the time, I, along with all the members of the investment team, will get an email from Bob saying that he's going to visit Houston or Toronto or Omaha and has a few hours free. So he wants to know what company have we been looking at that are located in those cities so he can call management and meet with them while he's there. Now, in 2009, Alan Weber responded to one of those emails saying Bob should go visit with Builders FirstSource in Houston. Of course, the CFO was available to meet with Bob because no one wanted to talk to him. Investors had fled. Wall Street wouldn't go anywhere near the stock. So Bob's talking to the CFO, and the CFO tells him that when we get back to building 1 million single-family homes in the US, we'll generate this much revenue with EBITDA margins of 8%. Now, 8% seemed aggressive, given that margins even at the peak of the housing bubble hadn't even reached 7%. But the CFO went on to explain that the company had spent the last 7 or 8 years going crazy buying businesses, slapping them together, and it was a bit of a mess. So now, with time on their hands, management was busy restructuring the business logically, and they were confident they would be able to generate at least 8% EBITDA margins. So that meant if demand recovered to 1 million single-family homes, the company should earn $1.50 per share of EBITDA. Now, of course, by 2009, the home building business had been decimated. Single-family homes built went from a peak of 1.7 million a year to less than 500,000 homes a year, which was less than half of the 50-year average at that time of a bit over 1 million single-family homes a year. But during those 50 years, both the population and the number of households in the US had doubled. So to think the industry could get back to at least 1 million homes wasn't a heroic prediction. Now, since this is a distribution business, which isn't at all capital intensive, EBITDA isn't really the misleading metric it could be in some other businesses. So Bob realized there might be an opportunity to buy a business for roughly 2 times pre-tax earnings. Now, the company did have some debt, but it had also been a long-time holding of 2 leading private equity firms who believed in the business. So Bob figured the worst case, those companies may have to inject some capital, meaning dilution. But even if that meant it was trading at 4 times, it was still clearly a tremendous bargain. So we got to work analyzing the industry, learning all we could about its competitive landscape. And we learned one of its competitors was the Boise Cascade distributor, BMC, which was coming out of bankruptcy. The company had restructured, lowered costs dramatically, and though it did have some debt, it was going to receive an $80 million tax refund within 6 months that would allow them to pay off all their debt. The company hadn't yet relisted, so it continued to trade in this gray market with shares that were then owned by lenders who ended up with equity in a business they didn't want and wanted to sell. So Bob took this information and went to talk to the company. And the company wanted someone like Bob to invest, someone who believed in the business and allowed management to keep their jobs. So we went around to the banks who held equity and ended up buying a 22% stake we bought it from them at a price that was substantially discounted because the stock had never relisted. So as a significant shareholder, Bob ended up joining the board. And that was very important. It was instrumental in allowing us to learn the business, learn what the company was doing and how they were doing things, and understand the entire opportunity set. It also gave us tremendous insight into the business of the industry. And significant opportunities came from that, but not without more pain. Now, it's interesting. It may even sound counterintuitive, but we actually want the pain sometimes to stay for longer periods of time. Because in general, the longer an industry is depressed, the more time there is for the cathartic process Bob mentioned to take place, meaning more consolidation, fewer competitors, more time for additional supply, and the larger the opportunity set for the well-run survivors to grow their earnings power in these downturns. So after initially buying shares of Builders at $3.40 in May of 2009, we doubled down in 2011 at $1.70. The opportunity was getting larger, but the price was getting cheaper. And the market wasn't interested at all because it couldn't identify when the business would change. But we had very high conviction that it would and had the patience to hold tight. Now, when we first got involved, the market capitalization of both Builders FirstSource and of BMC were both below $200 million, essentially microcaps. In the summer of 2020, Builders FirstSource and BMC announced they would merge. And today, the stock, which is a combination of what were once the four largest distributors, sells for roughly $135 a share and has a total market capitalization of over $16 billion. Not a microcap anymore. And the story isn't over yet. The dynamics of the business have changed dramatically. And we can see that from 2022 EBITDA margins of not just 8%, but 19%. And we estimate on a normalized basis are roughly 15%. Now, before I hand it back to Bob, I just want to pull on another connected thread to illustrate what he said and mentioned in the beginning about how people, our passion, and our collaboration are one of our biggest advantages. So when I joined the firm at the end of 2009, I began doing some work on Builders FirstSource and BMC. And that exposure, combined with my prior summer internship experience while I was in business school, where I spent an entire summer analyzing wallboard maker USG, allowed me to identify and recognize a unique supply-demand situation unfolding in the oriented strand board industry, where the same cyclical dynamics had taken place, and so much capacity had been taken out of the market that, again, if we reach just 1 million single-family homes, capacity utilization would rise well above 90%, giving producers significant pricing power. And if we got back to 1.2 million, there might even not be enough supply to satisfy all of the demand, meaning prices would spike, something no one was pricing into the stock. We initially invested in Canadian producer Ainsworth, which was bought out by Norbord, and eventually bought out by West Fraser, making them by far the largest OSB producer in the US. And indeed, supply constraints have caused prices to initially have gone up by more than 5 times to all-time highs. And while they've pulled back, they remain well above historical averages, generating significant cash flow for West Fraser. With that, I'll turn it back to Bob.
So actually, I'm going to go a little off script here. So because it's one of the things that really differentiates us, right? When it comes to value investing, long ago, I worked for Mario Gabelli. And right, I think Mario pretty much was one of the people at the advent of the use of the phrase value with catalyst, right? You don't want to own a value stock. There wasn't some event that was going to cause that the difference between price to value to dissipate. We don't invest, obviously, when we invested in Builders FirstSource, we didn't see what the catalyst was. There was no catalyst. But we were willing to take that long-dated opportunity, critical in that process, because we bought those businesses for far less than what it would cost. So we'd argue that we weren't buying $1 for 50 cents. We were probably buying $1 for 10, 15 cents. But an important component to doing that, to being in those things and not being concerned about being too early, is the ability also to not take a profit, not the idea that it doesn't hurt to take a profit is absolutely wrong. When you have something you bought as cheaply as we buy these businesses and has a long dated opportunity to take advantage of the opportunity set. So, because I do recall in 2015, right? So David said we bought it at 340 and 9, we bought it more at $1.70 and 11. So in 2015, the stock got to $11, $12 a share. They did an underwriting at $10. So therefore, Yes, you would have made a lot of money if you had sold the stock. The fact of the matter, as David pointed out today, the stock trades for $135 a share. So it was only at the beginning of the manifestation stage of the recovery in that business. There was a long dated opportunity, given how these companies had changed their position in the marketplace and the eventual consolidation of it, which is something that was in the works. Having been on the board of BMC, having spoken to the management of Builders FirstSource, that was something that was going to happen. There clearly was the logic and the motivation on the part of the owners to put those businesses together. So part of it is being able to stay in these businesses, not take a profit, not do some of those things, but really be able to fully capture the benefit, and also to not be stuck in a box, right? So we're not a small cap investor or a large cap investor, and therefore if a small cap investor does well and the company becomes tremendously a stronger, better business, to sell it because it's in the wrong market cap. So therefore we kind of break those rules. We do what's thoughtful and intelligent, not following some rule, and also clearly many cases investing in businesses with extremely long dated opportunities at extremely modest prices. And so that's a critical differentiator, we would think, between ourselves and a lot of other people in how we do invest, even in the value space. The fewer of us that are left investing in businesses like this that are cyclical, because that's, of course, something that most people don't do anymore today.